Welcome everyone to Tax Strategies, every real estate investor should know, featuring our special guest Mohammed. My name is Leah with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with check control. Brad is a solo 401k and SDIRA consultant here at Sense Financial, and he has a professional journey spanning over 18 years in real estate investing. Brad is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. So thank you so much for joining us today. And Brad, I'll let you take it from here.
All right, much appreciated. Sound check, video check. You guys can hear me okay, right?
Yeah.
Sounds perfect.
Awesome. All right, thank you. Yes, we are not a little more housekeeping. We're not a fiduciary. We don't provide legal or tax or investment advice or accounting advice. If you need such advice, please seek out the proper professional. This is educational only. We do have a CPA on as a guest, but again, this is educational only. If you need to discuss your specific situation with either me or our guest, we recommend you schedule a separate consultation for that. Just a quick few minutes here about what we do at Sense Financial, and then I'm going to get out of the way and let our guest take over. We are a boutique financial firm specializing in self-directed retirement plans with checkbook control. I'm going to talk a little bit more about that in a second. We've been around since 2010, so way past the startup phase. Our clients love us. We have hundreds of five-star reviews on Google, Better Business Bureau, Yelp, BiggerPockets, all over the place. And that number actually is not 4,000, it's 5,000. So we've assisted over 5,000 clients, established over 6,000 self-directed retirement plans. I need to update my slide there. And most of our clients come from referral. Most of our referrals come from our existing clients. And then we also get quite a bit of business from partners of ours, relationships we have with CPAs, with tax advisors, with people who operate syndications, real estate brokers, kind of all over the place. But I think the fact that our clients refer us is a reason to believe that we do a good job for our clients. So just briefly on the self-directed IRA and solo 401k, when you think about an IRA or a 401k, you're used to investing in the stock market. We call these public assets, right? Stocks, bonds, mutual funds, and ETFs. What the self-directed plans allow you to do is invest in alternative assets, which provides true diversification. When you're in Wall Street, even if you're diversified in the S&P 500 across the 500 quote-unquote strongest companies in the country, you're not really diversified truly because you're still in the stock market and you don't have control, right? With a self-directed account, it allows you to invest in things that you know, things that you have control over, or at least a lot more control over, providing true diversification. This is not instead of the stock market. You can do that. It's up to you, but it's in addition to the stock market as well. The returns can be tax deferred in a traditional pre-tax or in a Roth. That is true of the IRA or the 401k. They both have Roth available and traditional available. And you can use a non-recourse loan to finance a piece of real estate to buy double or more the amount of real estate in your IRA could otherwise afford, or 401k. Non-recourse just means you can't personally guarantee the loan. The property is the only security, right? So if there's a default situation, the lender can only go after the property, not the individual, because it's not an individual, it's an IRA. And then we offer checkbook control. That's what all of our plans have. Checkbook control is a super cool feature that allows our clients to bypass or eliminate the custodian when making investments. So it's a little bit of a lot more efficient way to invest. You control the money and you can do wire transfers, write a check, make deposits, pay bills without having to go through anybody else. You control it, okay? So it's a lot more efficient and a lot more cost effective as well. No transaction fees, no per asset fees like you would have in without checkbook control. And then the solo 401k is a true tax shelter. You can actually contribute up to, depending on circumstances, $81,250 a year, which is quite a bit more than the up to $8,000 a year for an IRA. And that can be Roth or traditional or a combination thereof. I mentioned investment options. These are some of the more common investment options that people choose from: residential real estate, commercial real estate, cryptocurrency, precious metals. Your IRA 401k can actually become the bank and do loans. You can loan to fix and flippers. We have many clients who are loaning over and over again to the same several fix and flippers who are getting 14% and 2 points on the loan in 3 to 6 month terms, and they just do that over and over again with their IRA or 401k. So it's pretty cool. And if there's a default situation, it's secured by real estate, right? And you could go foreclose on the property. Tax deeds, trust deed investing, the sky is almost the limit. In fact, the IRS doesn't tell you what you can invest in. They only tell you what you cannot invest in. And that's life insurance in an IRA and collectibles in both the IRA and the 401k. And then you have to be aware of disqualified parties and prohibited transactions, which is just basically you and your immediate family are off limits. Anything involving them is not okay. Anything that's third party or arm's length is usually okay. But we're here to answer those questions should you have them. I mentioned true diversification. You don't want to be like this elderly couple here where they have all their eggs in one basket and the basket falls and you lose either most or all the eggs. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And give me 1 second here. So sorry. I want to introduce my guest. But let me go to this. Yeah, so our guest speaker, Mohammed Yusuf, is a CPA and founder of Nexus Square, ABV, and ABV. He has been he's been in the industry for 25 years. And hold on 1 second. I am so sorry. Well, Mohammed, I am going to let you do a further introduction on yourself because I don't have your bio handy here, and I really apologize for that. So just add anything that I missed, but I can tell you guys from just me personally, I have gotten to know Mohammed over the last several months. We actually met on Bigger Pockets, which if you haven't experienced Bigger Pockets, you should definitely check it out. It's like Facebook for real estate investing. And Mohammed has a wealth of knowledge for business owners, real estate investors, and he understands self-directed retirement as well. And for me, that was really important to have in a CPA. So without further ado, I'm going to stop my screen share, and I'm going to let you take over, Mohammed.
Thank you, Brett. Let me just give me a second to share my presentation. How's that? Brett, do you see my screen?
Let's see, it's loading. Yes.
Okay, looks fine.
Yep, perfect.
All right, great. Hi, everyone. Thank you so much for joining today. Today we're going to talk about tax strategies every real estate investor should know. Also, there will be one section towards the end that will cover some of the most recent updates on the new tax bill, the One Big Beautiful Bill Act. Due to the timing of this webinar and presentation, it's only been 6 days, I want to say, since that new tax law has been signed. So I don't have a lot of information about it yet. Hopefully you understand that this is about 900 pages long. So all CPAs and accountants and tax attorneys are scrambling now to go through it, do research. Not everything is black and white, so it usually takes us some time to go through it, try to understand it, make sure that we know exactly how it could be implemented. There will definitely would be new forms in 2025 to reflect all the new changes. So there's a lot going on in taxes now in 2025. So we'll continue to work on it, and hopefully we'll get to the bottom of it. But there will be one slideshow towards the end of this webinar to highlight some of the changes that we are familiar with at this time. Real quick about myself before we start our presentation today is, again, my name is Mohammed. I'm a CPA and an ABV accredited in business valuation. I started my accounting career back in 1998. I started working for KPMG, which is one of the big 4 accounting firms. I only spent like a couple of years working there, and then moved on to work for, joined a mid-sized accounting firm in Newport Beach, California. And I spent the next 6 years with that accounting firm working mainly with real estate clients. It's usually a bigger size, large real estate funds. And I was focused on doing audits and compliance work. So basically we go in, review their financial statements, make sure that everything looks fine. If there's any errors, we catch it and then ask them to correct it. So I spent like about 6 years doing that, mainly working for large real estate funds. One thing that I noticed during my time with this accounting firm is, since we're working mainly with bigger real estate funds, is we are doing compliance work, we're doing the audit, we're finding mistakes or errors and asking them to fix it. But I remember one day, one of my clients came and said, I really appreciate all of what you guys do for us, but I feel like we're not getting enough support. We're not getting enough advisory type of work, meaning you tell us what to do, you make us stay compliant, but you don't tell us how to fix the issue. And that stuck with me ever since that day. I remember that one client. And we couldn't provide that type of service for a couple of reasons, because in audit there's some independence rules, professional rules, where we cannot tell the client how to fix an issue. We only find the issues and then ask the client to fix it. Another thing is we were not trained back then as an accountant working for the big firm. I was not trained on how to advise clients on how to do something specific in accounting or tax. I was not trained to do that. I was trained on how to find errors and ask the client to fix it. So ever since, I in my mind, I wanted to do something more closely work with the client to help them achieve something that they can see valuable to their business. So after spending 6 years with that accounting firm, in 2009, I started my own firm, Nexus Square. We're based in Southern California, Brea. And my focus at that time is just to work with smaller real estate funds, syndications, and large real estate investors. At that point, when I started, I was mainly focused on outsourced accounting and controller type of work, meaning I work on their monthly financial statements, I help them prepare it, maybe do some cash flow projections, and also help with the investor reporting. So all of these funds have a lot of real estate investors investing in that fund, and every month or every quarter we have to prepare certain financial statements that shows the returns from specific assets to each investor based on the amount of capital invested in that fund. So it's a little complicated report, and it's not easy to find someone that you can hire in-house to help with that type of reporting. So I found an opportunity when I started my business that I can go back to the clients that I used to serve working for the big accounting firm and tell them, I used to do the audit or compliance for you. Now I'm on my own. I can provide the services that you were looking for, which is some type of advisory work. I can hold your hand, help you with the accounting, and and then also help you with the financial reports, like some type of a CFO or a controller. It made sense for smaller funds to hire me because they don't have to go out and hire a full team in-house or maybe hire an in-house CFO. It made a lot of sense for them. So I started doing that, and then later on, my clients start asking me, how about taxes? Can you, we have those large partnership tax returns, they're very complicated, and we would rather have the same person doing the accounting and the tax returns at the same time. Can you do that? And I was like, I started doing tax returns just for the partnerships, and slowly, because my clients asked me to work on it, and then slowly got into preparing tax returns for real estate investors, like and the limited partners as well. And later on, like maybe 5 or 6 years ago, that's when I started learning about tax planning and strategy. So that only started like 5 or 6 years ago. So prior to my first interaction with tax planning, I was just a tax compliance person, meaning I'll get the information from your books, put it into the tax return, and file it, which was great. But when I start hearing about from some clients that we know a lot of CPA firms or accounting firms just file our tax returns, but we need something more. We need someone to tell us how we can save on taxes. And then so I started looking more into tax planning and strategy. And I noticed something. I noticed that real estate is like a lot of the tax planning rules or the tax strategies are tailored more towards real estate. So I did some additional training, and I started taking more courses on how to be good or work with my clients on helping them implement tax strategies that can help them save on taxes, and then use those tax savings to reinvest and maybe grow their portfolio. So I've been doing that for the last 6 years. Our firm is only focused on real estate. So there's a lot of accounting firms that are more like a generalist, meaning like they work with different types of industries. There's nothing wrong with that. But since my background, ever since I started my career in accounting, I worked with a lot of real estate clients. I wanted my firm to focus on the real estate. So today we're a team of 8. Half of them are tax advisors, other half are accounting and bookkeepers. And we intentionally limit the number of clients that we work with. And the reason is we wanted to work year-round with our tax clients. So, and the only way to do that is just to limit or put a cap of the number of clients that we work with. So at this point, we only have 150 clients that we're working with. We used to have more than 1,000 clients, and we gradually reduced that amount so we can focus on providing that type of service that the clients are looking for, which is, they always tell us that I want someone that can meet with me every month, every quarter, at least twice a year, talk about strategy. I can tell them about my plans, and they can tell me about what works for me, what doesn't work for me. I can tell them about the plans for the next 5 or 10 years and see if the tax strategy that I'm currently implementing still makes sense or not. So the way we're different than most of the other accounting firms, I'm not saying that we're the only ones, but the way we're different than most of the other accounting firms is 2 things. Number one is we're only focused on real estate. So if you go to our website, everything is real estate. So sometimes you will look at an accounting firm website and you will see that they serve different industries, maybe 7 or 8 different industries. There's nothing wrong with that, but you can only be good if you do one thing and you get better at it. So we decided to only work with real estate. We do not accept any clients who are not in the real estate, or at least do you want to get into the real estate game, or want to start in the real estate. And the other thing that differentiates us from the other accounting firms is we limit the number of clients intentionally, and the reason is we want to be able to provide that hands-on, face-to-face meeting regularly, just to talk about what's new in taxes, what works for them, what doesn't work for them, and also help them implement those strategies. Our mission is very simple. is to help our real estate investors keep more of what they make and then use those savings to reinvest and buy more properties or grow their wealth. So this was a little bit about me and my firm. Why tax strategy matters? Again, like I said, the real estate industry is one of the most favored tax asset, meaning, like I said, when I started looking at the tax planning or tax strategies, I noticed that most of the tax strategies, rules or laws are geared towards real estate investors. And I started looking more into this and trying to understand why is that. And then this is just when I realized that our lawmakers or policymakers or our government, through tax strategies or tax plans or tax laws, they are trying to force us towards a specific behavior. So, for example, like when the government wants us to build more houses or build more communities, they will provide tax incentives to real estate professionals. Another example that's not related to real estate could be trying to think about something. The renewable energy or the green energy. When the government wants us to lower our reliance on oil and gas, they start offering tax credits to people who invest or buy or install renewable energy products in their homes or their businesses. There's a lot of tax benefit provided to business owners if you buy a business, and the reason is the government wants us to start businesses and hire people and create jobs. Also, like for example, like if you own a house, you get to deduct your mortgage interest and your property tax. This is not available if you rent an apartment or a house because the government wants people to own houses. So think about it this way. Every tax strategy is the government is trying to enforce a specific behavior. Meaning, in this case, in our case, or today's presentation, the government wants us to build new communities. They want to direct investors to build in specific, certain, maybe underserved areas where there are no jobs, there are no houses. So they will say, if you go out in that area and build there, you will get tax benefit, you will get tax deduction, additional tax credits maybe. This is something they call the qualified opportunity zone. So this is why tax strategy matters. It's because the government wants us to learn about these strategies and utilize them to drive a specific behavior. Now, being familiar, number one, you have to be familiar with the tax laws and how each tax law affects you or benefits you. Number two is filing a tax return, like even like learning about the tax law or being familiar with the tax law is not enough. So when you file a tax return, it doesn't automatically qualify you for certain tax laws. So the CPA or the accounting firm that you are working with have to work with you. First, identify the tax strategies that you qualify for, and then secondly, implement it, and then making that election or claim on the tax return. Because if you're a real estate professional, filing a tax return, for example, doesn't make you qualify or doesn't make you claim a bonus depreciation or does a cost segregation for you. So you have to keep that in mind. You have to be familiar with the tax law relative to your industry, and then also work with someone that can help you implement and make those claims or take those deductions on your tax return. The problem if you don't do that is there's a lot of what we call missed cost. So I come across some clients that comes to us, and actually there's one specific example that just popped into my head right now. This client came to us like a year ago. She's been in the real estate business for 40 years. I want to say that her portfolio is about, at least she has more than 50 properties. She's been in this business for the last 40 or 50 years, probably. And when she came to us, she told me after we start reviewing her prior tax returns, and then I start my first planning meeting with her, and she said that no one ever mentioned to her cost segregation or bonus depreciation. This is a real estate investor, considered a large real estate investor. She owns more than 50 properties on her own. She also invests in other partnerships in real estate. And she never heard about, she kind of heard about it, I guess, maybe, but she didn't know that it's beneficial to her. So her CPA, her prior CPA, never brought it up or never mentioned to her that maybe this is something that she should consider and walk her through how to do it. Honestly, I don't have an exact amount how much this is of a missed opportunity or cost that client missed or lost, but I'm guessing over the last 40 or 50 years, it's probably like hundreds of thousands of dollars for not implementing or not qualifying or not using those tax benefits. So now that we understand why tax strategy, learning about tax strategy and understanding how to implement it is important, we're gonna start looking at some of the most popular tax strategies or tax laws available for real estate professionals. Some of these tax strategies work for business owners as well. But the one that we get asked about a lot, usually first when we get a new client, we get about maybe 5 leads per week, and majority of those leads, there is in the contact form, there's one section where we ask about what are you looking for, and what drove you to contact us. And I want to say that the majority of the responses, like I said, I look at at least five per week. The majority of the responses are two things. Number one, not in that specific order, but one is the entity structure. How can I set up my entity for real estate? And number two is the short-term rental strategy, which we're going to talk about shortly in one of the next slides. So my first tax strategy or tax benefit for real estate that I'm going to talk about is the different types of real estate entity structures. For someone who's just getting started in real estate, so let's say someone who owns like one single family house and he rents that house, and that's it. And let's say their net worth is not, they don't have a lot of other significant assets. I usually say, you know what, you don't need to incorporate yet. I understand that a lot of real estate investors are concerned about asset protection and liability protection, but for this specific client that comes to us with, let's say, one rental property and it's just a single family house, I usually say that make sure that you have an adequate insurance policy. It's better actually to have like some kind of an umbrella liability protection, or usually they go up to, the limits are like $3 million or $5 million. For that type of small portfolio, like one rental property, you own it 100%, you just rent it. I honestly don't think that there is a need to overcomplicate or make anything more complicated. If you don't want to set up an entity yet, at least in the beginning, that's fine. The one thing that I would advise you to do is just to make sure that you have a very good insurance policy to cover you and your assets also in case of there's a lawsuit or a claim. From my experience, having one single family house that's rented, the chances that you would get sued is very, very minimum. You never know, but if that's the worst case, I mean, even if that happens, if you have the right insurance policy, you are protected. Setting up a single family LLC or a partnership or an S corporation in this case is not really warranted, but if you have to, I would say that you should maybe start with a single member LLC. What is a single member LLC? It's an LLC that's owned by one person. So the reason why we recommend this starting out in the beginning in real estate is it's the simplest form to incorporate. So it will provide that asset protection, the legal liability, the legal protection, and liability protection. And then also, it's very simple to set up. It's very, the cost of maintenance is very low because it doesn't require a separate tax return. So basically, for a single member LLC, all the rental activity gets reported on a Schedule E on your 1040. You don't have to file a separate tax return for it. In certain states, you have to file a separate return, but for federal tax purposes, there's no need to file a separate tax return other than your 1040. For that reason, the deadline for filing your personal tax return is April 15, and it can be extended to October 15. It's very, very simple to set it up. Now, and then one more thing about the single member LLC, it has to be owned by one person. So let's say a husband and wife, or a person and their spouse, if they set up an LLC and they both own shares in that LLC, so for example, like 50-50, 75-25, all of a sudden, this is not a single member LLC. It's a partnership. So as long as once you have more than one member, it automatically turns into a partnership, which we'll talk about next. So starting out, just keep it simple, just single member LLC. It will save you a lot of trouble and makes it very easy to report your taxes because it's part of your personal tax return. The next one is the partnership. As your real estate portfolio start to grow, or maybe if you start to think about getting in some type of a venture capital, or maybe a partnership with other investors, then that's when it makes sense to set up a partnership or an LLC that's treated as a partnership. So again, once there's more than one member, it automatically is treated as a partnership. Partnership has to file Form 1065. It's a separate form, and it's due by March 15. So it's 1 month earlier than the 1040. So it has to be done by March 15, and then if not, there's an extension that can be requested that will push that deadline to September 15. So partnership, again, is good when it gets a little bit more complicated. Keep something in mind that it's very important when you're looking at a partnership is you have to set up an operating agreement. You might have to go to an attorney or a lawyer to help you with that. And the purpose of the operating agreement is just to it document the allocation of how the profit and loss will be allocated between the different members. It's usually based on the percentage of ownership. So let's say if it's a 50-50 partnership, 50% of the income or loss will be allocated to partner number one, and the other 50% will be allocated to partner number two. But sometimes there are special allocations that are made, and that's why you might need to go to a lawyer to help you draft that agreement or create that operating agreement. Types of special allocations could be like, for example, like depreciation. So let's say we have two partners that decided to go into a partnership to buy an asset. One partner will put all the capital required for the down payment. The other partner will manage it. Maybe the partner who put the capital, this will agree with the other partner that, you know what, we can split the profit. It's okay to split the profit, but I want something more. I want, for example, like the depreciation to be allocated 100% to myself because I put all the capital in it. So this is considered like a special allocation. For that reason, if it gets that complicated, then you will need to go to an attorney to help you draft that operating agreement. The next
Mohammed, we have probably about 10 minutes until we have to start getting into the Q&A, just as a heads up. Okay, so you might want to
go faster.
Yes, please.
Okay, I'm sorry. Okay.
That's okay. That's okay. Right. It's all great info, man. I just want to make sure we get to the good stuff about real estate specifically.
Yeah, but please, like keep me posted because I tend to forget and I keep talking. But
that's okay.
I'll try to make it short, 10 minutes. Cool. So the next entity structure is the S corporation, which is it makes more sense as an S corporation if you're actively managing real estate. So think about like different LLCs. Each one has different assets, different investors, and you're the one who's managing all of these different LLCs. S corporation might make sense. Keep in mind, S corporation, you will need to pay yourself a reasonable compensation and pay employment taxes. The good thing about the S corporation that you can actually set up a solo 401k. That's something that Brett maybe can help you with, and you can use that 401k to invest in more real estate. The last entity structured, C corporation. Everyone heard about it. I rarely hear about it in real estate. In my whole 25 years career in real estate or accounting, I only came across one. In that case, maybe it made sense. It was set up by the prior CPA. In that case, the investor or the real estate professional actually is in the business of fix and flip. So they don't get any. Fix and flip is like when you buy a property and sell it, fix it and sell it within 2 or 3 months. You don't get any beneficial treatment. It's the income is treated is taxed as regular income. In that case, C corporation and also they have a very high volume of fix and flips. In that case, it made sense because C corporation has the lowest tax rate compared to other type of business structures. The only problem with C corporation is if you try to make a distribution to yourself or take money out of the company, there's a double taxation. So that's it for the entity structure: single member LLC, partnership, S corporation, and C corporation. The next tax strategy I want to talk about quickly is cost segregation. And before I can talk about cost segregation, I have to talk about depreciation. What is depreciation? It's the most powerful tax benefit. A lot of people go into real estate for a value or asset appreciation and value, cash flow, and then depreciation. Depreciation is it's a non-cash deduction. So basically, you take the cost of the asset divided by 27 years for residential properties or 39 years for commercial properties, and you take that amount. It's non-cash, but you get a deduction on your tax return for that amount. So a quick example, which let's say you have a real estate property that generates $100,000 of rental income per year. 70,000 is paid to between like mortgage and property taxes and utilities and repairs. So the net rental income is 30,000. You will actually get 30,000 in your bank account, but and then let's say depreciation is 10,000. You only gonna pay taxes on the 20,000. You don't pay taxes on the depreciation, even though you received 30,000 in your bank account. So the good thing about depreciation is it's a non-cash deduction. You get a deduction for it, you get a tax benefit for it, but you don't have to pay for it. In the same year. So that's depreciation. Now, what is cost segregation? Cost segregation is basically taking the value of the cost of a property minus the land and breaking it into smaller components. So anything that's not related to the structure, think about like maybe electrical fixtures, furniture, maybe flooring, maybe roof. This stuff, an engineering firm can get involved, and during that process of the cost segregation, they will break down the total cost into smaller components. Usually they have a shorter period of depreciation, so let's say typically 5 or 7 or 15 years. So think about it that way. And instead of depreciating your cost over 27 and a half years or 39 years, you can depreciate it over 5, 7, or 15 years. It's a much shorter period, which will provide more benefit. The next step when you do a cost segregation is a bonus depreciation. So this has been recently reinstated in the most recent tax bill. So 100% bonus depreciation is back. How is that linked with the cost segregation? The tax law for bonus depreciation is most of the qualified asset that has a useful life of 15 years or less, based on the cost segregation, might qualify for the 100% bonus depreciation. A case study, this is a recent client that we're just working with. He has 5 properties in San Diego, California, bought it between 2019 and 2023. We sent him out to do cost segregation, came back, we worked on his tax return and the tax strategy. The first year increase in depreciation expense is $250,000, which resulted in a $75,000 tax savings. That client this year, because we did the cost segregation and we applied for the bonus depreciation, his tax liability went down by $75,000. In this specific client, I know that he's going to use the $75,000, and instead of paying the IRS, he's going to use that $75,000 as a down payment for the next property. That's how powerful depreciation, cost segregation, and bonus depreciation, which is back, is in real estate. Now let me move on to the next one, 1031 exchange. Very powerful again. This is the process of exchanging, sometimes referred to as the like-kind exchange, but this is a process where an investor can exchange one property into a similar or like-kind investment property and while deferring the gain. So when you sell a property, if you do it the right way and follow the rules of the 1031 exchange, you don't have to pay any taxes on the gain from the sale of the first property, as long as you reinvest 100% of the proceeds into the next property. What is a like-kind property? It doesn't have to be a single family for a single family. It could be a single family for an apartment building, a residential property for commercial, land held for sale into a shopping center. As long as it's an investment for investment, it should work. Keep in mind that there are specific rules that if you don't adhere to, it's not a 1031. It's not a qualified 1031 exchange. You have to identify the replacement property within 45 days, and you have to close on the replacement properties within 180 days. Make sure to identify a 1031 exchange intermediary before you list your property. So if you list your property and start looking for someone to help with the 1031 exchange, it's too late. So always plan for this in advance. If you know that you might sell a property, like let's say in the next 1 or 2 years, start talking to your CPA, start looking for a 1031 exchange intermediary. Maybe that will help you actually identify. They usually work with sponsors that can help you identify the replacement property. Very powerful tool or strategy. You don't have to. I know clients that built their portfolio from 1 duplex to 400 doors or 400 units using that one strategy. Over the last 40 years, they paid zero in taxes. They've been deferring the gain on the sale and investing that gain into the next property. They went from a duplex in Buena Park. Now they own 400 apartment building in Las Vegas. The next tax strategy is the short-term rental, one of the most popular tax strategies that work in, and also the real estate professional status. All real estate income and losses is passive, meaning that you can only use the losses from real estate to offset passive income, usually from real estate or some type of passive business investment. Now, what is short-term real estate and real estate professional status? If you qualify for one of these two strategies, you actually can use the losses from real estate to offset other type of income. Short-term rental, it's Airbnb. You qualify for a short-term rental is a short-term rental by definition if you rent it for 7 days or less. So think about Airbnb. And then also you materially participate in that activity, meaning you spend at least 100 hours managing the property and more than anyone else, or 500 hours, regardless of how many hours anyone else spent on the property, or substantially all of the hours spent on that activity is one person, which is you. If it's even if it's less than 100 or 500 hours. Basically, if you qualify for the short-term rental strategy, you can use the losses from the rental activity. It could be due to the bonus depreciation, all these cash and non-cash deductions and losses. You can use that to offset your active income. That's number one. Number two is the real estate professional status. This only qualifies if you're in the real estate business, meaning think about real estate agents, brokers, property managers. To qualify for the real estate professional status, you have to spend at least 750 hours and more than 50% of your working hours in real estate activity or trade. Not anyone can qualify for this. A lot of people can qualify for the STR or the short-term rental if you do it right. The key factor about the STR and the REPS or the real estate professional status is the documentation. A lot of leads or a lot of clients come to us and they have very bad documentation. I'm sorry, I posted a very small example of the proper documentation, but you have to keep a proper time log to document your material participation hours, whether it's the 100 hours, 500 hours, or the 750 hours in the case of the real estate professional status. This is just a very small example, but just to give you an idea, it has to be to show the date, the property address, the number of hours, and then also a very detailed description. So for example, like a very bad example of a time log is I spent 50 hours in June managing a property. The IRS will not accept that. It has to be very detailed, as the example shown on the screen. We have templates, so if anyone listening would like to have a free template on how to keep track of their time log for STR or reps, please feel free to reach out to me. I will be happy to share that template. It's an Excel sheet or Google sheet. So that's it for the STR and the estate professional status. Quickly, the top 5 mistakes we see working with clients that came to us. Commingling funds. You cannot commingle personal and business funds. So if you have a business, if you have a real estate activity, please make sure to have separate bank accounts for your personal and your business. Do not commingle, do not use one bank account. Not planning for exit, meaning that you're not talking with your CPA or your tax attorney early enough about your plans to sell in the near future. So once you sell, you might end up paying a lot of taxes if you don't do it right. So there are options, which is like, for example, like the 1031 exchange we talked about, or reinvesting in a qualified opportunity zone. Failing to keep material participation logs, we just talked about this. If you overstate, inflate, or just use average numbers, you will get audited and the IRS will not accept it, and they will reverse all the deductions. It's not going to be good. So make sure as you work throughout the whole year managing your properties, you're keeping very good record of how you're spending your time on the real estate. Overlooking state and local tax. You incorporate in different states based on where the asset is located or where the property is located, and you're not aware that I actually have to file taxes in that state. That's one of the top 5 mistakes we see. Sticking with outdated entity structure. Your CPA advised you 20 years ago to set up, like, let's say, an S corporation or LLC. This was maybe good idea 20 years ago. Today it might not be a good idea. So always, you regularly have to check with your CPA, especially because your situation changed and then also the tax laws change. So whatever was beneficial for you 20 years ago might not be beneficial to you this year or going forward, depending on your plans. Planning opportunities. What do you keep in mind? Try to take this out of today and think about it. See if any of this applies to you. Talk to your CPA. Reach out to us. I will be glad to discuss it more. Review the entity structure annually, at least once a year with your CPA. Explore cost segregation. If you're thinking about buying a new property or maybe making improvement in real estate, think about cost segregation. Talk to your CPA about it, and bonus depreciation. 1031 exchange, keep that in mind. If you're thinking about selling a property soon and you don't care about cashing out and you don't want to pay taxes, 1031 might be a great idea to reinvest the gain without paying taxes into the next property. Explore STR, short-term rental, to offset your W-2 income. If you a high earner and you don't mind, maybe you have a spouse that stay at home, maybe you don't mind owning a short-term rental and managing it, that might be a great way to save taxes on your high W-2 income if done correctly. Please do not do this on your own. Once the IRS starts seeing big deduction or a lot of deduction and tax return, it's a red flag. It's not wrong, but you have to do it right. But the chances that your tax return will get audited is much, much higher when you start claiming the STR and the real estate professional status. Keep that in mind. Do not do it on your own, please, if you don't have accounting or tax background. Finally, coordinating with financing strategies. If you're trying to start in real estate, think about setting up maybe a solo 401k, talk to Brett, or a self-directed IRA, and see how you can maybe use your retirement to start investing in real estate. I know that a lot of you were waiting on this slide, and I'm sorry that I'm running out of time. But quickly, the One Big Beautiful Bill Act was signed into law on July 4th. I personally did not have a lot of time to research it. I went through it just for the purpose of this webinar. I came up with 5 things that I think will make sense to most of our listeners. Number 1, everyone is excited about in real estate, the restoration of the 100% bonus depreciation. The bonus depreciation was phasing out. The last time it was 100% was in 22 and 23. In 2023, went down to 80%. In 2024, went down to 60%. In 2025, up till July 3rd, it was supposed to go down to 40%. Luckily, they restored it to 100%. So if you buy a property anytime or put it in service, place it in service anytime after January 19, 2025 and going forward, if you do the cost certification, you might qualify for the 100% bonus depreciation. Very great news. It's back, 100% bonus depreciation. That's what I got excited most about in this new tax bill. Number two is the adjustment to the state and local tax, the SALT deduction. I don't know where you're listening from. I'm in California. It's considered one of the high income tax states. We pay a lot of income taxes. Similar if you're in New York maybe or New Jersey. These are states that taxpayers pay a lot of taxes in when they live in it. So the SALT deduction, or the state and local tax deduction, which basically covers your state-owned income taxes and property taxes, was limited to $10,000. They increased that cap to $40,000. In California, this is great news. Now I pay income taxes, high income taxes in the state of California. I pay property taxes. I will be able to deduct much more than $10,000. I have up to $40,000 now to deduct on my federal tax return. Tax relief for workers, this is great news. This is another example how our government are trying to incentivize specific behaviors. So I think maybe they noticed that people in the restaurant industry are struggling to find workers. So now they introduced that new tax law, which means that if part of your compensation is tip or overtime, if you get a lot of tips, you have $25,000 of tax-free income. So the first $25,000 of the tip, the money that you made in tips, is tax-free. If you work overtime, I think you have up to $12,500. Again, please, this is just fairly new. I'm still trying to understand, but I believe what I just said is true. If anything, I might have to follow up and correct myself. The child tax credit got a little enhancement, not huge, but it went up from $2,000 to $2,200. It works for most of taxpayers. The auto loan interest deduction, and I'm not sure exactly what the point of this, but any cars that the final assembly is in the U.S. So keep in mind, my understanding that it doesn't have to be an American car. It doesn't have to be a Ford. So let's say it might be a Japanese or a German car that's finally assembled in the U.S. If you buy this car, you get to deduct up to $10,000 in interest. And my understanding that you don't have to itemize deduction to claim that. So I think even if you use the standard deduction, you'll get to claim that interest deduction too if you buy a new car in 2025. Don't quote me in this. I believe that it's not. You can still claim it if you use the standard deduction. That's what I heard. But this is all I have about the new tax bill. As we learn more, as we research it more, we're gonna continue to maybe write blog posts, which we show on our website. So if you would like to go to our website, there's a blog page. You can follow us and stay up to date with as we research more, we learn more about the new tax bill. That's it for me, and I'm sorry that I went over the time. Brett, are you here?
I am. Yeah, no worries, man. That was amazing stuff. Thank you so much for the time. And just as a quick note, we do have a few questions, so we'll try and get through as many as we can here in the next few minutes. But hello at nexussquare2s's.com. Hello at nexussquare.com is Mohammed's email. If you're just listening to this and you don't see the screen, then you can definitely get a hold of him that way, as well as go to his website, nexussquare.com. So, all right. Well, that said, we do have a few questions, actually. I think some good ones, possibly some that were kind of answered because they came in before you got to the certain topic. But I might bounce around here a little bit based on certain things. Sandra's in New York. Yes, Sandra. See, at least here, in California, we have great weather. Why do you guys in New Jersey and New York put up with high taxes? I don't get it. But anyway. All right. V is asking, are there any common mistakes that would make it, and I think you kind of covered this, bad documentation? This is probably in reference to the reps status, I would think.
Very great question. We deal with this a lot. Yes. So just to explain it, using average or inflated numbers. So again, in my example was when I look at a log and the real estate investor has let's say one line item, 50 hours in June, and then the description is managing property. He did not specify the exact date. He did not specify the exact number of hours, and he did not specify the address. So let's say if you own or invest in 10 properties and you manage all of them, you cannot just say, the IRS doesn't like it. I'm not the bad person. The IRS will disqualify. You cannot use average numbers. You cannot, so 50. You cannot use inflated numbers. It has to be very detailed. I believe there's one slideshow that has an example. So the right way to do it is I think 4 or 5 columns at a minimum. One column for the date, one column for the number of hours, one column for the address, and one column for the description. A very detailed description. Just to give you an example, maybe communicating if it's a short-term rental, client or customer or guest communication is at least 3 or 4 hours every time you turn guests. So client communication is an example. Maybe managing the cleaning crew. It has to be that specific, or maybe supervising the contractor that is building the ADU, or supervising hiring a plumber or buying furniture. It has to be that specific. So please do not put one line item, 50 hours in June, in the month of June, and then the description is managing property. It will not work with the IRS.
And also, I'll add, Mohammed is kind enough to share his template that he mentioned. So
yes.
Just email him and ask for that template, and he'll get that over to you.
Yes.
Yeah.
Yes.
Okay, how does depreciation allocation affect partnerships? I didn't quite catch that part.
Okay, so this is not very common. So it's not very common. So again, I don't want you to overthink it, but we sometimes come across that, let's say 3 or 4 partners in one partnership, and for some reason, maybe because of how each person invested in that partnership, how each investor or person invested, maybe one person put more capital, so he wants more benefits, and the benefit could be in the form of, let's say, I will claim more depreciation deduction. So let's say if the depreciation on that one building in the partnership is $1,000 as an example, that partner A in the operating agreement will say, because I put more cash in, I put all the cash required for the down payment to buy that asset, I will get to claim all the depreciation on the K1. Oh, maybe I understand maybe where the question came from. So partnerships do not pay taxes. So partnerships is a pass-through. So there's a K1 form. So each partner in a partnership will get a K1 form for his or her share of the partnership income or loss. So normally the K1, normally your share could be based on your capital share, which is let's say 30-40 or 50-50. But maybe one partner, in my example, will say, even though I'll only get, I'll get 30% of the income from the rental activity, I want to be able to claim 100% of the depreciation. This is called special allocation. It's not very straightforward. It's not like you will get 50% of the income or loss and I'll get the 50%. No, we're making changes to the regular allocation. So this way on my K1, I will get more deduction, which I can claim on my personal tax return, which will reduce my taxes. This is what I mean by special allocation.
Yeah. can get complicated sometimes, but I think you did a good job explaining that.
Yeah.
And then lastly, again, you may have covered this because it came in before you got to the short-term rental part. But LE is asking, not sure if I got this the right place to ask, are there any self-employment taxes applicable to short-term rental income? I'm considering having one.
Wow. This is not covered in this presentation. This goes back to a great debate between a lot of CPAs or accountants. How do you file taxes for your short-term rental? So I've seen accounting firms putting the short-term rental activity on a Schedule C. So let's say usually it's owned by one person. So and for that reason it gets reported on your 1040, your individual tax return. There's two forms in that 1040, form Schedule C and then Schedule E. Some accounting firms will present or report the short-term rental activity on Schedule C. Some accounting firms or CPAs will report the short-term rental on Schedule E. Where do you report this will answer that question. So if the short-term rental is reported on Schedule C, there will be self-employment taxes. If the short-term rental is reported on Schedule E, there is no self-employment taxes on anything reported on Schedule E. What my firm does, we report it on Schedule E.
E, like Edward?
E, yeah. Which is mainly for passive activity or real estate activity.
Yeah, and this question, Ellie, thank you so much for asking it. It comes up all the time when I'm doing consultations for solo 401k and self-directed IRA, because a lot of people have STRs, and they're wondering if that alone qualifies them as being self-employed to have a solo 401k. And my question to them is always exactly what you said, Mohammed. It's, how are you reporting the income?
Right, exactly. Yeah.
And a lot of times you'd be shocked, and maybe you wouldn't, Mohammed, but a lot of times they're like, I don't really know how I'm reporting the income. I'm going to have to go check my tax return or talk to my CPA. But
Right.
at the end of the day, it's like, yeah, you gotta talk with your CPA about how to do that. But
Yeah.
I will just add this: Schedule E income is passive income. It does not qualify you for quote unquote legitimate business activity to have a solo 401k. That is not self-employed. That is not what that is. So that won't work. But yeah, it's a great topic. Thank you so much for Ellie. That's probably
By the way, like a couple of
question.
months ago, I wrote a blog post about how to file taxes for a short-term rental. So if any of your listeners would like to read more about this topic, if you go to our website SenseFinancial.com, in the blog section, there is a blog that I believe it was about 2 months ago that I wrote that blog about how to report the short-term rental, and it will explain if it's reported on Schedule C, this will happen. If it's reported on Schedule E, this will happen. So hopefully that would help.
Oh, that's great. Yeah, thank you so much. I'm trying to find the link while we're wrapping up here, but anything else you would like to add, Mohammed? I'll give you the last word.
No, thank you so much for inviting me. It's been a pleasure joining you. Thank you for all of your listeners that tuned in today. I hope it was helpful. Maybe you got something or at least one thing out of it. If there's anything that I said maybe it was not clear enough or confusing, please feel free to reach out to me. The email address is hello@nexasquare.com. Also, if you go to our website, there's the contact page. Please feel free to fill out that contact form. Let us know what your question is about, and we'll make sure that we'll get back to you right away.
All right. Thank you so much, everybody. Really appreciate it. Until next time.